When I think about how sustainability and ESG related information can affect the financial statements, I look at it from the auditor's basic consideration of anything that can affect the financial statements, which is, what are the business operations of the entity? Where are they doing business? Who are they doing business with? And how is all of that recorded in the general ledger and the books and records of the company? And when we think about things like climate, or we think about supply chain or workforce considerations, those actions and the items that are influencing the company's operations need to be considered from a financial statement perspective. So focusing specifically on climate, when we think about the elements of climate risk, we're talking about two things. We're talking about physical risks from climate change, and we're talking about transition risks from the changing business models or markets in which the company operates. And as an auditor, we have to think about how does each of those individually or collectively influence the items that are recorded or disclosed in the financial statements. And simply because they're climate matters, they don't affect the considerations we make as auditors about what is our responsibility here. It's always about the transparency, the objectiveness, the completeness, and the accuracy of what's recorded and disclosed. And climate-related items have the same exact potential influence, and they can affect the financial statements the same way that terms, contractual terms, or costs can affect. And when we think about specific areas of the financial statements, how climate can affect the financial statements, the physical risks affect things like fixed assets and inventories. Is there a risk that those will no longer be accessible to the organization? May they be damaged? May they need to be retired or replaced earlier? And how do those influence things like our depreciable lives, the amortization we take, the fair value of those assets? When we think about transition risk, we're thinking about cash flows, we're thinking about going concern, we're thinking about impairment, because the operations and the changes that a company may undertake or that its markets may experience will influence the amounts that we record or may need to record in the future, and those impact the base under which that we record many things from a financial perspective.